January CPI coming in hotter than expected. Joining us now on the takeaways for the Federal Reserve, former Fed Governor Mishkin. He's now a Columbia University professor and a CNBC contributor. And, you know, things come in vogue, things go out of vogue. Rick, there was a time after the 50 basis points sort of surprise, shock and awe cut, and then a couple more. There was a time where people said, are you sure that inflation has been put to bed? And the last mile is tough. And, you know, the economy, are you sure the risks are symmetrical? Because the economy, jobs market were holding up pretty well. So there's a question as to why cut. I mean, is that being borne out now, that mission accomplished, that banner was put up too soon?
Yeah, you know, I actually thought that I mean, in hindsight, but the 50 basis point cut was actually a mistake. You know, it came after they thought they made a mistake when they didn't cut, and in fact, the numbers came in a little weaker than they expected. But the bottom line is that the mission is not accomplished. The inflation has fallen, but on the other hand, it's sort of stalled at a level which is above the Fed's 2% inflation target. That the job market, if anything, the labor market is still slightly on the tight side. And the Fed's maybe a little bit restrictive in terms of its numbers, but not that restrictive. And then, you know, we have a lot of uncertainty about what's going to happen, particularly in terms of tariffs. And that's like a self-inflicted supply shock, a negative supply shock. It's going to hurt the U.S. economy, but also raise inflation. And it's being done, you know, usually we get those because something bad happens. But in this case, it's something that the Trump administration is pushing very hard.
Right. And with what's maybe still in the pipeline, combined with, you know, these proposed tariffs, which, you know, some are coming even sooner maybe than March 1st. The president's saying that interest rates should be lowered. I mean, maybe interest rates should be actually, if you got tariffs coming and you've got residual inflation from whatever caused it, you know, to get to 40-year highs, it's not a time you're going to be cutting rates. You might be raising rates.
Well, yeah, I don't think the Fed has to think about raising rates at this point. There's still.
What about if tariffs come? What if there's tariffs? What if there's another couple hot prints?
Yeah, the tariffs are complicated, but they are a supply shock, and typically the Fed looks through those supply shocks. It doesn't try to react to them too much. But on the other hand, you know, look, that these policies are not particularly helpful, that Trump is a low interest rate man. You know, he said he's a tariff man. He loves tariffs. He also loves low interest rates. This is one of the reasons why it's very important to have an independent Fed that is able to look to the long term, not sort of get into the short term type thinking. But, you know, politicians do this all the time. Trump is no exception. Maybe a little more extreme on some things, but he's certainly no exception to the typical politician who always would like the Fed to goose up the economy and create jobs. But that's not the Fed's job. The Fed's job is to basically keep a good long-run policy that keeps inflation under control, which is a pro-growth policy. That's what the Fed's supposed to do. And I think, you know, Jay certainly understands this, and the Fed as an institution understands this. And, you know, Trump can say whatever he wants. The big issue is going to come up when he's getting ready to appoint a new Fed chairman. That's when things really become much more complicated. Right now, the Fed's just going to ignore what Trump is saying, not what he's doing, because that can affect numbers. But what he's saying and his push on them, they resisted very well in the past during his first administration. They're just going to do it again.
Why wouldn't some of the cool numbers we saw on inflation, you know, not this month, but previously, why wouldn't those be the lows? Why should we have any hope that we're not now, that we haven't, maybe the inflection point hasn't been reached? It'd have to be a weaker economy, wouldn't it? Would there be any reason for inflation to come down from where it is right now? And if not, we are not 2%. So I don't see why, you know, I don't understand why we're going to have more cuts. You think we'll get a weaker economy that will help? Otherwise, inflation's headed back up.
I think this is why the Fed basically now is in a pause phase, that they're basically just going to be in wait and see, that they're still mildly restrictive. And also, one of the things that as long as the Fed has credibility to get inflation down, inflation will gravitate to 2%. That 2% target really does help in that regard. To basically give an anchor to where the inflation is going to go. And in fact, you know, when I was on the Board of Governors, And people frequently say, what was your prediction for inflation? I would say, well, I think inflation expectation is still rock solid at 2%. They'll head there. So I think it depends a lot on what the numbers are. The Fed, I think, has been handling itself quite well since 2022, when it previously made some bad mistakes, but turned things around very quickly. And I think they'll do the job. And I think the markets understand that they'll do the job as well.